Good morning, everyone. Welcome to this update for global stocks and commodities for the 12th of June. And it seems that every week these days carries some sort of major piece of news or major move in markets. And I just get the feeling that that we're really building up to perhaps some major moves around the UK referendum on leaving the Eurozone. And so there certainly are some short-term signs that we might be seeing some changes in current trends, at least on a short-term basis. I'm not really seeing anything that would suggest a longer-term change, but certainly I think we're in a period now where we could see some considerable volatility. So let's have a look at what's occurred over the last week. Look, first of all, I'd like to start with just a bit of an overview, big picture look at what's happened with quantitative easing by central banks, because that really has driven stock markets higher. It drove the gold markets significantly lower for a period of 3 or 4 years, but that now seems to have reversed for other reasons. So I think it's just worth reviewing at a big picture level where we've come from. Now, to me, the real game changers were when the US Fed in late 2012 announced QE3. QE1 and QE2 had certain defined parameters around them, whereas QE3 was pretty much open-ended. It was as much as it required for as long as it was required. And also, Mario Draghi at the ECB has said the same thing and is still saying it. Even to this day, and he's still claiming that it's working, but I think he's absolutely dreaming. But both of those major federal banks have been providing basically an open-ended quantitative easing or monetary stimulus, monetary printing, whatever you want to call it, to the global economy. And this has been taken by investors as providing some sort of implicit assurance that that they wanted to push stock markets higher. And in fact, quite clearly, that has been stated quite openly, particularly in America, that they wanted to create a wealth effect so that people would go out and spend. And that wealth effect was primarily going to happen through the stock market. And I think central banks have been really quite successful in achieving that. They've certainly pushed the stock markets up much higher than they otherwise would have been. Where it has failed, of course, is that people haven't gone out and spent because they've been increasingly concerned about what's going on. Now, that QE program caused a massive liquidation in gold. Now, for a lot of gold investors, they hold gold as insurance, as portfolio diversification, as an alternative to being in stocks. And when they're concerned about stocks, there's various things that they can do, and one of them is adding to their holdings in precious metals in their portfolios. Because people felt that basically the stock markets had a floor put under them, that there was no requirement for that level of portfolio diversification. And so we saw this massive liquidation in gold, which had run from around $250 an ounce to nearly $2,000 an ounce over a period of about 11 years. And so that was quite a dramatic change in gold. Now, the other thing that has occurred is that we've now seen a reversal in gold demand, which started in January. And the price of gold is now rising, and in the very short term is rising against some very obvious headwinds, which I'll talk about in a slide or two. And also that reversal in gold demand. So this is the physical buying by investors has occurred at a time when, okay, the gold price has gone up a bit, but when you look at the big picture chart, not that much really. It's still really consolidating at the top end of a big base that's been in existence now for a couple of years. So it's not as though people are rushing out to buy gold because they're seeing the gold price going up. And that's incredibly bullish when you see the demand for gold, which is occurring through GLD, and I'll talk more about that in a minute. And also, of course, you see gold stocks rising very, very strongly. So very, very bullish signs. Now, there are some signs of some short-term change, which is really the point of this week's video. And we shouldn't ignore them because those short-term changes could be quite substantial. So specifically, there has certainly been a bit of a rush into bonds, particularly towards the end of the week. So people are buying bonds, and that, of course, is forcing yields down. And there's a pretty interesting graphic coming up next just to show you the extent of that. So that means that people are going into what they perceive as a safer area than and stocks, and that's why we saw stocks reverse on Friday. Also, to the bond spread, which is the difference in yield between the high quality end and the lower quality end of the bond market, is getting wider again, and that's indicating that people are either going more into the high quality end and therefore with a lower yield and pushing that yield lower, or alternatively they're getting out of the high yield end, which is the riskier end, because they're concerned about where that might go. So that widening of bond spreads is certainly indicating some caution. Now, all of this could just be related to the Brexit vote, the UK referendum on the 23rd of June. And once we get past that and know the result, we may go back to the medium to longer term trends that have been in place now for some time. However, it could also be, and this is typically what happens, is that bond yields are pointing, or bond yields doing what they're doing now, are pointing to a weaker economy. We won't know that until we get past this situation with the UK referendum, which is really kind of muddying the waters a bit at the moment, making it hard to feel really confident about anything, because we just don't know whether the moves are indicative of just short-term caution or whether they're actually a change in trend. Now, this is the chart of 10-year bond yields. The green line at the top is the US 10-year. Below that's the UK. And then we've got Germany in blue. And then, of course, Japan in the orange. And you'll notice that Japan has had a negative 10-year yield since early this year. Now, the key things to take away from this is that all yields are still falling. They're still trending downwards, which means that bond prices are going up. So people are buying bonds, causing their prices to rise and yields to fall. And the second thing is that the bond yield, even though it's unbelievably low in the US, is still better than the UK and Germany and certainly Japan. And so that means that if you are a global investor and you're looking for the best deal, even though the US is a terrible deal, it's at least a bit better than some of the others. And that's why we saw a rise in the US dollar on Thursday and Friday, was global money coming out of the UK, Germany 10-year bonds and going into the US 10-year bonds. So look, I know for a lot of you this won't mean a great deal because the bond market is not something that the mainstream has much involvement with, but it really is critical to the whole mix. If you're not paying attention to what's happening in the bond market and just looking at the stock market in isolation, then you're almost getting no picture at all. So it's a very, very integral part of being aware of what's happening in the stock market. Now, the S&P ended up down 3 points on the week. The big story was this collapse in bond yields. Now, on its own, that's not a good sign for stocks, because normally if people are going into bonds, then money is coming out of stocks to go into bonds. But look, we've got so many other things going on at the moment. The UK referendum vote and economic data. There's a whole lot of things here. So I'm not prepared to say that the normal relationship between bonds and stocks will apply in this case. However, we did see the European and UK markets spike lower on Friday. We'll take a look at those in a minute. And the US dollar rose, of course, because of those yield differentials. So you can get, even though it's a bad deal, you can get a better deal on US treasuries than you can on Europeans. The rise in the US dollar caused crude oil to fall by 3%, which is a pretty big move on Friday. But interestingly, or not interestingly, quite surprisingly, gold actually went higher on Friday night when crude oil was falling. So that just shows you the demand factor that's coming in for gold. Now, the other point I want to make is that, June, July, August is traditionally the weakest time of the year. Doesn't mean it happens every year, but if there's going to be some selling, then this is the time that it may occur. And there were certainly some reversals to pay attention to on Friday. Technically, looking at the market, the US market, there are supports at 2085 and 2070. The same as last week, and of course the resistance is the all-time highs at 2130. So let's take a look at the S&P. First of all, on the big picture monthly chart, so you're looking at about nearly 20 years of data on that chart. You can see we had the massive uptrend from 2009. Initially, when this market started to break down in August of 2015, it was quite possible that this was a major trend change. However, this has gone on long enough now for it to certainly raise the possibility that all this is a consolidation, and that at some point we are going to get a breakout to the upside. And at the moment, if I had to flip a coin, I've probably got to go a little bit with a breakout to the upside and a renewal of the uptrend. Now, I know that flies in the face of fundamental valuations and a whole lot of other reasons, but as I've been pointing out strenuously over many, many months, we've just got to trade what we see, trade what's in front of us. And if the market is showing us that it wants to break out into another new bull market, then so be it. That's what we go with. That's about as good a read as I can give you at the moment. The short-term direction is being really, really muddied by all the decisions this month. We've got the Fed on interest rates. I don't think they'll move on that. We've got the UK referendum. We've got the Spanish elections. We've got the Bank of Japan is also meeting. So there's an enormous number of trigger points. Let's look at the S&P on a daily chart. Sorry, that's not the S&P at all. This is the S&P. So you can see we pushed up to a high of 2120, so getting very, very close to that all-time high on Wednesday. And then on Friday, you can see we got a bit of a reversal. Now, it's not a major reversal by any stretch of the imagination, but at least it was a bit different to what we'd seen. We haven't really seen a day like that for the best part of a month. So whether it's just related to short-term triggers, who knows? We'll find out shortly. Now I just want to take a quick look at the volatility index. Did kick up on Friday. You can see we've been trading down around these extraordinary lows, down around 12, all things considered. These are extraordinary lows. There should be a lot more fear in the market at the moment. And we finally saw a kick up to around 15.5 on Friday. So maybe just some moves in the volatility market. Let's have a look at the European indices. This is the FTSE, the UK index. Now you can see, as opposed to, this looks a lot more like the Australian market, as opposed to the US, which has been close to all-time highs. You can see here the red 200-day moving average line is still trending down. The index is struggling to hold above it, and that was a fairly decent reversal on Thursday and Friday. We're seeing the same pattern in the DAX. You can see the 200-day moving average has been in negative mode now since December of last year. And again, quite a significant move in the German market on Friday night, down around 2.5%. Now, the other thing that's important, of course, is currencies. So here's the US dollar index, and we've looked at this chart quite regularly. This level at 92 is absolutely critical. It goes back a long, long way. So we first saw lows starting to form around this level in 1998, and it's been a significant support and then a significant resistance level for a long time. That's 18 years. We've seen further support provided here in August and again in May. We then got a bit of a run higher, and then that suddenly reversed with that just absolutely shocking jobs report the Friday before last. But then in the last 2 days, you can see we've seen this quite abrupt reversal, which has brought commodity prices down, but also failed to bring the gold price down, which is what you would normally expect. So pretty interesting chart, that one. Now, just while I'm here, looking at the Australian dollar, we spiked higher, got up to 75 on the back of the falling US dollar. But then you can see we came off quite sharply and finished the week under 74 on Friday night. So really just tracking there with the US dollar. Looking now at the ASX 200, so it still can't get through this 5400s resistance level. I would imagine we will be down on Monday. Quite possibly the futures indicating down here around 52.50. So we could be sliding back to the bottom of the range in the Australian market. So I've pretty much covered all this. The other thing that you may have read through the week, because it's getting a lot of publicity, first came out early in the week when I first read it, but has been popping up every day since, is a very well publicised 40-cent Australian dollar forecast by one of the major investment banks. I actually concur with almost everything that's written from the fundamental point of view in the article, and I've been saying that for many, many years, that Australia has been basically spending way beyond its means, and that a huge cultural shift needed to occur in Australia to avoid ending up like like some of the South American countries and some of the European countries in an absolute debt and growth disaster. And I think that's absolutely where we're headed. I'm not sure that I can go as far as saying a 40-cent forecast is realistic, but certainly I think 60 cents is incredibly likely. 50 cents is possible, but I think the Australian dollar is in a long-term downtrend, and I don't see anything above 70 cents as being sustainable. If you haven't read that article, then just Google it. You'll find it in all sorts of places. I think it's something well worth reading. The ASX index down by 7, but will slip further on Monday morning. And on Friday, commodity price weakness certainly spiked the major miners. And the banks finished the week in the negative as well. So they're still selling in the banks. And as I've been saying, I think that reflects the fact that overseas people are expecting the Australian dollar to track lower over time, and so they're not wanting to hold as much of Australian equities as they did before. Now, turning to precious metals, gold was higher by $30 on the week, so by far the strongest commodity. And we're seeing some real proof of surging investment demand via the amount of shares being bought in GLD. Now, GLD is an ETF. It's basically a proxy for the buying of gold. It's an alternative rather than buying physical gold and storing it somewhere. And with all the costs involved in that, you can just buy an ETF that if you buy shares in the ETF, then the ETF immediately goes out and buys physical gold. So every dollar is covered by an equivalent amount of gold. And so that's a figure that comes out every day. So there's no ifs, buts, or maybes. You can see that money is flowing into or out of GLD, and I've got some very interesting stats to show you on the next slide. The fact remains that portfolios around the world remain hugely underinvested in gold. A lot of financial planners will tell you that somewhere between 3 and 5% gold is a key part of a portfolio. Not that I necessarily agree with those static models, but that's what is generally recommended. And at the moment, on average, people are holding around about 0.1 to 0.2% of their portfolio is in gold. So massive, massive underinvestment in gold. And if that attitude changes, then there's a huge amount of buying that has to happen. Now, also too, over recent months, I've been talking about the ratio between the gold stock indices, either HUI or GDX, whichever you like, and the ratio of that price to the gold price. And in the case of the HUI ratio, we're still looking at being at a very low 0.18. Now, the norm would be closer to about 0.45 to 0.5. So we've made a little bit of ground. At the lows, it got down to 0.11. So we certainly have surged back to a degree, but we're still way short of the normal level. And all markets revert to the mean. And that's why I think gold stocks have still got a long, long way to go, even if the price of gold doesn't move. Now, precious metal stocks, we did see a reversal candle on Friday, and I'm pretty cautious about what I saw on Friday in the short term. You know, I've been talking about the need for a retracement, a pullback in gold stocks, and I think Friday might have been the start of that. So gold and silver went higher on Friday night impressively against the trend, which is indicating that surging investor demand for the physical. But we did see stocks trade down. Stocks have had a fantastic run. Some of them are up close to 200% from the December lows. And to get a pullback would be quite normal. So all I'm talking about here is caution, because the market really has run a long way without a pullback, and we might just finally be going to get that pullback. So just beware of the fundamentals and the technical seasonality of where we are at the moment. So I've definitely turned a little bit more cautious during the week when gold stocks just kept surging against all the odds. I started to think that the pullback was finished. What happened on Friday night causes me to move back to the camp of just be careful for the next 2, 3, 4 weeks. I think there's a much stronger chance now that we'll see lower prices and a better entry opportunity. Now, hopefully this is not too confusing a slide, but look, this is absolutely fundamentally critical to understanding what's happening with the gold price and gold stocks. This table shows the money that's being pulled out of GLD, which is the ETF that tracks gold. So that's the middle column. And the right-hand column is the additions to GLD. And of course, this is on a quarter-by-quarter basis. So you can see as the gold bear market took hold in 2013, and throughout 2014, you could see there was some massive reductions in GLD holdings. At the peak, there were about 1,350 tonnes of gold in GLD. And you can see the massive reductions that occurred during 2013 and 2014. Now, there's the odd little quarter here where there was a little bit of buying went into GLD, but you can see it was very minor and only sporadic. So all the way into the end of 2015, we saw net reductions. People were selling shares in GLD, which meant that gold was being sold out of GLD. As we move now into Q1 of the March quarter of 2016, you can see the massive buying that suddenly spiked into GLD. So huge amount of buying of GLD shares, and therefore that particular fund manager has to go out and buy physical gold. And he bought 177 tons of it, which is a lot of gold. And that progress hasn't slowed, because already in the second quarter to date, there's been 62 tons added. This is data that's available every day. It's something that I track. Anyone can track it, and I think it's absolutely fundamental to understanding what's happening in the gold market, because if people are consistently wanting to buy physical gold, on a daily basis, then ultimately the gold price and stocks are going to follow. Moving on to other commodities, copper was flat at 204, which was, sorry, it wasn't flat, it was actually down a little bit. And that's not a good sign for economic growth. I think it was about 208 the week before. Crude oil, West Texas crude oil was slightly higher at 49.1, but that was after a big drop on Friday night. So it had been trading up around 52. So that key resistance level for oil is holding. There's the spot copper chart. You can see there's been a significant fall from $2.30 in April, and we're now starting to get down towards the lows the lows for the year. So to wrap it up, and this slide is fairly similar to last week because I just think it's the most succinct way that I can express how you should be positioned at the moment. We've got a lot of major triggers in June. We're getting very close to the start of them. There's about 5 or 6 of them, and so markets are frantically trying to anticipate which way all these decisions are going to go. So as a consequence, I think it makes sense to raise your cash level to exploit any short-term weakness. We saw reversals in all the stock markets around the world on Friday. We saw a reversal in gold stocks from a gap higher to ending up trading down near their lows. So we could see a short-term pullback in gold stocks. So I just think it really makes sense to raise your cash levels. Expect turbulence, but probably new highs in the medium to longer term. And the reason that I say that is because where else do investors go? You know, it's just crazy to be buying bonds at this stage. I know a lot of people are doing it, but it's just absolute absurdity to be accepting such incredibly low rates. Property also looks pretty dicey at the moment. So where else do you go? They go into stocks or they go into tangible assets like gold. So I think new highs are possible, but we do need to see earnings growth come through in the US. The stock markets are looking forward and they're assuming earnings growth of 12 to 15%. If that doesn't happen, then you'll see stock markets fall to come back into line with fundamentals. When it comes to precious metal stocks, I think the only way to play it is to hold a core holding and look for perhaps a 10, maybe 15% pullback that I've been looking for now for a number of weeks, and that will provide a better entry. So my position on precious metals completely unchanged. All we're talking about here is short term. Members know very clearly about what's going on and how to position themselves with a lot of specific information. For those who aren't members who would like some assistance, there's my contact details. That's it for this week. Sorry, another long one, but gee, just so much happening at the moment. Talk to you next week. Cheers.